Welcome back to All Things Money. I'm David Blain, and during today's show we're covering a few of the tax hikes that are headed your way in 2011. For those of you that don't know, we have a lot of expertise in our company in taxes. We manage the tax planning as well as tax preparation for about 95% of our clients. We believe that true wealth management encompasses not only investing and the traditional topics, but also encompasses a heavy dose of tax planning. And so we do a lot of this for clients. So if any of the things that I'm mentioning today, if you have more questions on, feel free to give us a call at 633-0107. Email us at allthingsmoney@dlblain.com. That's allthingsmoney@dlblain.com. Or as always, pull us up on your BlackBerry or iPhone at www.dlblain.com. That's dlblain.com, and you'll find archives of the show as well as contact information to get a hold of us. If you're not doing any tax planning now, if you have a CPA and you're happy with them and they're not doing tax planning, give us a call. We'll be glad to help you with that. You can keep your CPA, but we really think if you're not doing tax planning, you're going to be in a lot of trouble come next year. This is especially true for three classes of people: your investors, people that have a lot of investments and liquid assets, your real estate investors, and your small businesses. Those are the three main categories of people: small business owners, real estate investors, and people with a lot of liquid assets that tax planning is really beneficial to. If you just have a regular job and go to work and get a paycheck and don't have a lot of other financial complexity, tax planning is very difficult. There's not a lot you can do to save money. So anyway, back to we were talking about starting in 2011, a lot of the tax cuts that were enacted in 2001 and 2003 are going to expire. We left off with the death tax, which is coming back next year with a vengeance. There'll be a $1 million exemption. Beyond $1 million, the estate tax will start at 55%. Now, I need to make a comment, too. There are a couple of caveats to this. Number one is you can pass an unlimited amount of money to your spouse at death. So when one spouse dies, you can pass it all tax-free to your spouse. So what we're really talking about, the estate tax kicks in if you are a single person, if your spouse has passed away, or you're not married or divorced or whatever. But for someone that's married, it can all go to your spouse tax-free. So I was mentioning with the Chicago Cubs a couple of years ago, the family that owned the Chicago Cubs, the owner died, and they had this big, because they valued the Chicago Cubs. It was an asset that was owned by the gentleman that died, and so they had this massive tax bill that they had to pay. Well, they didn't have enough liquid money. All the money was tied up in the Chicago Cubs, and so they were forced to sell the Cubs to the Tribune to get enough money to pay the taxes for the IRS. And by the way, the taxes are due. You have to file the tax return within 9 months of death. And so you can imagine someone that has a lot of net worth in a small business or a farm or even a big business, when that person dies, they have 9 months to come up with 55% tax on over $1 million. The other thing I mention is when you're talking about $1 million, you take grandpa, the baby boomer, a couple $100,000, in the bank, a nice paid off home, maybe they have a beach house. You're very quickly getting up to $1 million. If they have some life insurance that is in the estate, it can go over $1 million very, very quickly. And I've seen this happen many times where children will come in after their parents died and they say, well, we've inherited this money, but we're losing all of it, or not all of it, but a lot of it to estate tax. What can we do? Well, at that point, unfortunately, there's nothing that you can, there's not much you can do. The time to plan for it is now. So if you have questions on this, give us a call. We work with some of the top estate planning attorneys in New Bern and frankly around the country to help make sure that you pay the least amount of death tax as possible. Of course, you may want your money to go to the IRS. If that's the case, well, then we recommend that you do no estate planning and just pass away and have your kids write the check to the IRS. Other taxes that are coming in 2011, the capital gains tax is going to rise from 15% to 20% in 2011, and that is bad enough, discouraging the investment of capital. But the real kicker is the dividends tax is going to rise from 15% to the highest marginal tax rate of 39.6%. They will rise another 3.8% in 2013. And so for all the investors out there that have enjoyed the preferential treatment for dividends at the capital gains rate, that's going away next year. And dividends will now be taxed the same as interest income. This really hurts the investors, and it hurts retirees living on dividends and interest to raise these type of rates. Sure, it benefits wealthy people that have a lot of assets to keep their tax rate low, but we see a lot of retirees with the uncertainty surrounding Social Security and things like that. People are encouraged to save and invest on their own, and then when they get there, when they're 60, 65, 70, and they're living on their capital gains, they're living on their dividends, they're living on the interest, to raise the taxes on them, to me, is unconscionable to do that to people. Well, it's time for our next break. When we come back, we'll finish up on this topic of increases in taxes. For All Things Money, I'm David Blain.